Curious as to why you're not as bullish on the other metals, gold and uranium.
You're talking almost $4,000 an ounce. That is a much taller order, David. Or even for silver, a 50% increase takes you to around 45, which is close to an all-time high nominally. Even if all of these potential near-term sources of supply come online on schedule, it won't be enough to meet the demand.
Is inflation returning? Well, that's what the Fed is probably worried about. Should we be worried about it? We'll talk about the outlook for inflation, monetary policy, economic growth, and which assets have the best room to climb in 2025. Lobo Tiggre is here to break down all this with us. He is the editor of the Independent Speculator.com. Good seeing you again, Lobo. We can check out Lobo's last interview with us way back in September. It's been a couple months. Lots has changed. New president, new monetary policy, new fiscal policies. Welcome back.
Thank you, David. Yes, a lot to talk about.
Let's start by talking about the latest inflation numbers coming out of the U.S. and also Japan this week. Surprised investors and participants of the markets alike with a higher than anticipated inflation rate. So we'll talk about the Bank of Japan. The Bank of Japan has kept rates unchanged at the last meeting. Possibly they'll hike in January. We'll see. But the latest CPI print from the U.S., 2.7%, was a little bit higher than the previous month. The Federal Reserve this week signaled that they're going to wait for more data before, signaling more rate cuts. So the markets really didn't like that
But
message.
they cut anyway.
Shut off. Yeah, they cut anyway in December because they already telegraphed it. Will they cut again? Let's start there.
So you've brought up several things, and let's tease this apart. There's some important threads here.
Yeah.
One is Japan is an outlier. They paused. The UK paused as well. The Fed didn't pause, but arguably should have, given the data. But Japan paused on their way up, right? They were late to the game. They're way behind everybody else. So they've been raising rates now, and they paused. And now we got a higher than expected inflation print there. So I can see more hikes coming from them. They still have that issue, but that's, they also have weakness at the same time. So, stagflation is not just a UK problem. It'll be interesting to see how things go. And given the sluggishness in the economy, it's not surprising that they paused. But they haven't beaten inflation yet, clearly. So they're between a rock and a hard place. It'll be very interesting to see how that plays out. Back to your question with the Fed, we got the higher than expected CPI, but we got, it's funny. We often joke about Mr. Market being a cycle, but this was so fully on display this week. Well, we had a 1,000-point drop in the Dow. As you and I are recording Friday, it hasn't gone up $1,000 points yet, but it was over 800 at some point. It's such a yo-yo because everybody is so data dependent, because the Fed is so data dependent, and the data keeps, surprising people. Now, the surprise du jour is that PCE went up. Like this uptick inflation that we're seeing, it's not just in Japan, it's not just in the UK or the EU, it's just about everywhere except China, perhaps. But this PCE number came in less up than expected. So it was a beat. Woohoo! PCE didn't rise as much as we thought it would, but it still rose. It's so striking to me how Mr. Market went risk on today. Woohoo! Inflation went up less than expected, completely dismissing the point that it went up. And that's as mismeasured by PCE, which is the most sort of dovish measure that the Fed likes to highlight on because it makes their job easier, I think. So the takeaways from this are, to me, that you will hear, dear audience, that you'll hear the mainstream media, you'll hear the talking heads, you'll hear the powers that be telling you, oh, this inflation doesn't matter, this increase doesn't matter, nothing goes in a straight line up or down, it's just a bump on the road. But I think the Fed's actions belie this. And I think why we saw this big volatility this week was because, this hawkish cut that we got, this so-called hawkish cut, right? They did deliver the cut. They were sort of painted into a corner on that. If they didn't deliver that cut, with the market having expected it by 97, 98%, they would really have caused potentially systemic volatility that they don't want to do. But they cut anyway, even though they knew that inflation has been going up, and not just 1 month, 2 months now. And the PCE is the easier one to anticipate. You have the input data and they can calculate it in advance. So they knew that PCE was going to come out higher and they cut anyway. So this is what I'm telling the audience. The takeaway here is look at what they do, not what they say. And in my view, despite the hawkish cut, and the rhetoric and so on, the Fed knows that the U.S. economy is weaker than it seems. Fiscal dominance, Lynn Alden's theme, as you well know, David, has helped mask this, but the economy is still weaker than they're admitting. And I think this is why they're cutting in the face of higher inflation.
Well,
now, where do you want to go from there?
They've already cut by 100 basis points since September, since we last spoke. So I think the question people have on their minds is whether or not inflation is coming back because of monetary policy, or perhaps it's coming back for other reasons, or perhaps it's not coming back at all. Where do you stand on the outlook?
I think it's coming back. I'm trying to be reasonable here. I think there's a very good chance that it's put in a low and that it'll just keep going higher over 2025. It may not. We may still see more cooling in housing, which is a big part of CPI. So we may still see some cooling ahead. But if so, I think that's pretty temporary. Everybody's all got their knickers in a twist about Trump tariffs being inflationary. I'm not convinced that's really it. I think that's actually a bit of misdirection. There's so much money flooding out of Washington already before Trump gets in there.
Yeah.
And it takes time for that money to percolate through the economy. We are running wartime levels of deficit spending with no war. And while at the same time, we're, like multi-trillion-dollar deficits. And yet the government is telling us we've got the greatest economy ever. Right. The narrative right now from the losers on the U.S. stage is, oh, we're handing Trump this wonderful economy. Everything is great. Inflation is licked and the economy is humming along. Everything is wonderful. While at the same time, they're running wartime levels of deficit spending. And Trump is not proposing to cut that. Arguably, you could say, oh, well, Doge will cut spending. Yeah, well, easier said than done. That's been promised before. Ronald Reagan tried it. And even he couldn't do it. So I think it's, at the very least, premature and optimistic to conclude that the Trump administration, which has promised not to cut any of the sacred cows, is going to significantly reduce costs or spending from Washington at all. But tax cuts are popular. And we promised tax cuts on, no more tips. Tax, firemen and policemen shouldn't be taxed. Just about everybody has some kind of tax cut promised.
Before we continue with the video, I want to tell you about one of the best performing assets this year, gold. The price of gold keeps rising. It's no mystery why. The Chinese central bank is stockpiling gold in the face of deglobalization, while Chinese citizens are buying gold hand over fist to protect their wealth amidst a real estate crisis, a stock market going nowhere, and low interest rates. All seismic shifts for a country that enjoyed immense growth for 20 years. These forces are here to stay, and they're strong. They've created such momentum that gold is now attracting interest from Western investors. The chart is bullish, the arguments are many, and the move is still young. When gold rises, companies putting new gold mines into production usually rise the most. It's called leverage. West Red Lake Gold Mines, today's sponsor, is one of the few Canadian gold stocks putting a gold mine into production in this exciting gold market. The Matson Gold Mine is largely built, and West Red Lake Gold knows exactly what it needs to do and when to achieve its goal of getting this high-grade gold mine back in operation in 2025. West Red Lake Gold is a stock made for this gold market. Learn more in the link down below or scan this QR code here. But what I want to know is whether or not your expectations for inflation and monetary policy are different from what the Fed signaled. Because ultimately, if you and other market participants are expecting one thing and the Fed's saying another, we're going to get another nasty surprise like what we got this Wednesday.
Yes.
Right.
Yes. That is what I'm saying. I mean, just think about it. Do a seat of the pants check here, David, or audience. I mean, the crazy volatility that we're seeing in the markets, and people rushing into risk assets and rushing out of it. This is not healthy behavior. And the nosebleed valuations are, as much FOMO as anything else. I mean, very, very few bulls, even mainstream Wall Street bulls, that are out there saying, no, no, stocks are really cheap. These are really rational valuations that, we're discounting the growth from AI or whatever. And, how many people are going to tell you that one of these market darlings with 200 PE, right? That's a reasonable value. Almost nobody, even on the mainstream, is saying this. And yet the FOMO is so real. But then some contrary data comes up that scares people. And I think that's why we're seeing this. If you take a deep breath and you think about how, yes, markets can be crazy, markets can remain irrational longer than you can remain solvent. We have all these sayings. But how often have you really seen a market acting so jittery, so crazy, so skittish? And FOMO is really not a sound basis for investment. Never mind speculation, right? But I do think that, well, to your specific question, I think the Fed is hoping that inflation will come down more and hoping that the jobs market won't weaken anymore and they'll get a get out of jail free card.
Okay, well,
but I don't invest on hope. I don't think either of those hopes is sound. I think both are at risk.
one more question on inflation. We'll move on to something else. You tweeted, or you posted on X that sticky inflation is a global phenomenon. I'll just share my screen so you know exactly which tweet I'm referring to. Is the money printing, so no surprise. Inflation gauge. We talked about the Bank of Japan. We talked about inflation in Japan. What is going on? What is this global phenomenon you're referring to?
Well, fiscal dominance. There was a
Okay.
lot of money printing, and it takes a while for the pig to go through the python. So yeah, it's easier to pull inflation back from 9%, as even mainstream folks were saying. Getting that final mile down to 2% was going to be harder. And I think at the time, 2 years ago, when people were saying this, it was presumed that the government spending all the stimmy checks and all the money flooding out from Washington, that would be cut off as the pandemic emergency supposedly receded. But it hasn't. We're still spending trillions. We're still, so the key point here is, dear audience, you're going to hear mainstream media and the powers that be telling you that the blip in inflation in the US doesn't matter. Everything's under control. We're on our way to 2%, that magical nirvana, and it's just a bump on the road. And the importance of the tweet that you highlighted, or post on X that you've highlighted, David, is that if it was just the US, you might statistically be able to make that argument, but it's global. This is happening in sync everywhere. The UK is seeing higher inflation. Europe is seeing higher inflation. Japan is seeing higher inflation. Arguably China is the only real outlier here. So this is a global phenomenon, as inflation itself was a global phenomenon in response to the global largesse that we saw.
You don't think that the new Treasury Secretary you brought up, Scott Bessent, let's talk about that. He wants to reduce a deficit. Isn't that going to be the opposite of the fiscal impulse that we saw?
Oh, he wants things. I want things too. Is Santa going to bring me a smaller deficit? Sorry, but this is actually another really important takeaway here. There is so much optimism out there. It's not just FOMO. There is a sense, you can hear it, it's palpable, and not just on the interviewers. Sorry, no offense to an interviewer in this interview, but to their guests, to the analysts, to the guys from the bankers on Wall Street and all these folks. This optimism about how we're going to have this more efficient, pro-business government. Even people didn't like Trump are saying, yeah, well, I don't like Trump, but at least he's more pro-business, and that's going to be good for my investments. But this is all giving Trump 2.0 a great deal of advance credit for campaign promises. I mean, seriously, what grown-up human being believes campaign promises? Even if you like the candidate, even if you agree with the candidate, it's still a campaign promise. So I think this is an important takeaway. The markets are pricing in success, not only before it's happened, but success that has never happened. If Ronald Reagan and the Grace Commission couldn't cut anything that they promised, government spending went up under Ronald Reagan, higher than ever before, as I recall, by the end of his term. If Reagan, who was a true believer in this, couldn't make it happen, could the art of the deal Donald Trump make it happen? and I'm sorry if I offend any Trump fans here, but I'm trying to be realistic. I'm
Yeah.
not trying to be,
Okay.
agreeing with you in your echo chamber. I'm telling you, we all know, how do you know a politician's lying? Their lips are moving. So show me, don't tell me. And sorry, Doge, I mean, even just to call it that as a joke, that's Elon at his best, right? So let's see things actually happen. And by the way, if they do actually manage to cut something, if we do actually increase government efficiency, that in and of itself causes near-term pain. I'm not saying they shouldn't. And by the way, please don't take anything that I've just said as being opposed to cutting taxes or opposed to cutting regulation in government. I think that's great. I'm all for it. I'm just saying, got a bit of silver in my beard here. I've watched politicians promise this sort of thing before, and they have never delivered. Like, never. Milei right now in Argentina is the only example in my entire life I can think of anybody doing anything remotely like this. And I just don't see it in the US. Show me, don't tell me.
Fair point, Lobo. So not a lot of confidence in the reduction of the deficit. Take a look at what's going on currently, though. As you know, there's been some back and forth this week about whether or not the government's going to get shut down. House GOP is making some progress. Speaker Mike Johnson is saying on Friday today that the House would vote on a new spending plan without President-elect Donald Trump's demand to suspend the debt limit emerging from a 2-hour GOP meeting. Johnson said he was finalizing the details. What's your take on this? Are we getting a government shutdown? Um, if so, how severe would it be? It's looking like they're coming to some sort of resolution, he said, adding, "We will not have a government shutdown." We'll see.
Yeah, I heard that too. A very confident announcement there. You know, David, I don't care. This is silly. I mean, seriously, I don't care. This will have no impact. It has never had any impact. They always punt at the last minute. If there is a government shutdown over the weekend, that won't even change anything. And if, everybody's talking about, well, everybody on the left is talking about, oh, how terrible it is to tell these poor, hardworking government employees they're not getting paid right before the holidays. That's BS. Everybody knows they're going to get paid anyway. Eventually, they'll make a deal. And, if their paychecks are even delayed, which is not a given, it all gets paid anyway in the end. So it makes no difference. It's a complete circus and a distraction. Pay no attention. Focus on the real action. What's going on? And the markets are signaling jitteriness. The Fed, with this hawkish pause, is implicitly admitting to the weakness in the economy that you and I have spoken about. And and yet at the same time, they also understand that inflation has been stickier, as we're talking about in this interview. And so they're trying to have their cake and eat it too. And I do think that they are going to have, something's got to give here, and it's not going to work out nicely for the Fed.
Are you still in the hard landing camp? We've talked about this several times before. You were calling for a hard landing throughout the year. What's your view now? Have you changed your outlook? Have you stuck with it? Are you pushing it back? What's going on?
Yeah, so I did say undeniable recession by the end of this year. With 11 days left as we record, that's obviously not going to happen. All the key economic data, especially with PCE out today, there is no data point that can make recession in the U.S. undeniable. Now, it doesn't mean there has been no recession. We have had manufacturing recession, we've had a commodities recession, we've had a recession, a rolling recession on several fronts. But I don't want to try to escape responsibility. I did say undeniable recession by the end of this year. That was wrong. But I do think it's important to say that doesn't mean that everything is fine. And you could argue, okay, well, we've got this strong GDP growth and people are spending, and that fiscal dominance that you're talking about, that could mean soft landing or no landing. That is true. The amount of spend, the amount of capital injections, even with the Fed tightening, if Congress is loosening at the same time and swamping out monetary policy with fiscal policy, that's what Lynn means by this. We will see apparent health, but I see this as being like a patient in the hospital who's hooked up to a heart, an artificial heart, and artificial lungs, and the doctor saying, look at his rosy cheeks. He's fine. Look, he's the picture of health. Well, sure, but turn off the machines injecting all the life into him, and he's not. So, I don't think there were no consequences to the Fed's tightening. I don't think that the um, the economy is as healthy as people say. And it's striking to me that actually, despite the fiscal denominator, despite trillions of dollars in deficit spending, we have still seen a weakening labor market. And in my view, this actually substantiates that people like me were right that there was going to be harm done by the Fed throttling the economy. That's their whole idea of how to control inflation, is to throttle the economy. They did throttle the economy. And okay, where does this leave us as investors? We can argue about whether it's hard, soft, whatever, doesn't matter. What matters is, if the reason why we don't have an undeniable recession is fiscal largesse, that's inflationary. And that affects our outlook for where we're investing going into 2025. And, if anything, the fact that gold is held so close to all-time nominal highs backs up my view that this is inflationary. Gold, as you and I have talked, the Big Mac index and all that, gold doesn't correlate with CPI, it leads it. So for gold to be remaining so high, I think tells us that we're looking at more inflation ahead. And I think, sorry, again, not to beat up on Trump, I'm all in favor of cutting government waste and regulation, but his agenda is inflationary. And so as an investor, step aside from the politics,
Sure.
I'm looking at an inflationary environment. Obviously this is good for monetary metals, but I also think after things shake out here and we pull through whatever weakness is left in the economy, it's good for commodities as a whole, and particularly any commodities, minerals, my specialty, that are looking at supply constraints. And the number one on that list for me is copper. Actually, my highest conviction trade for 2025, David, is neither gold nor silver, or even uranium, much as I still like that. It is copper.
Yeah, I still have to update my gold to Big Mac ratio. I have to do that. McDonald's is getting expensive where I live, so it's time to update that. But let's talk about copper since you brought it up. Copper has not done well since it peaked in earlier in May. Then it has double top in September. But it's just trailing down. Some experts have told me that this is signaling a global slowdown. Dr. Copper usually,
Right.
leads that. I'll let you talk about that. Also, I want to bring up the fact that it's had a pretty close correlation with gold, and a pretty close correlation. Well, actually, no, gold's kind of broken out since August, but it has had a pretty close correlation with silver. I understand that silver may be a byproduct of some copper ores, so that may be the reason. But I'll let you comment on, first of all, your outlook on copper, and then second, the relationship between copper and some other metals here.
Sure. I want to be very clear on this, in that I'm not saying the bottom is in for copper or buy right now.
Okay.
I'm saying over the course of 2025, my highest conviction trade is that copper will go higher. I am still not buying right now. I've discussed with clients some put strategies to take advantage of potential lower prices, especially when Trump gets into office and starts slapping tariffs left and right. If that happens as promised, the last time Trump did this in 2017, it did whack copper and metals and mining stocks pretty hard. So it doesn't guarantee, past may not always guarantee the future, but that is the most recent example of the closest thing we have here. So I want to be very clear on that. I'm not saying rush out and buy copper stocks right now. I am saying that I've got a shopping list. I'm refining it. I'm looking for new entries, and I'm looking for an obvious buying opportunity. The chart that you're showing me, we've talked about the weakness globally. My outlook has been for some time generally stagflationary, and we are seeing that around the world. And this copper chart fits in with that. But what I'm saying is that as push comes to shove, governments, not just the US, but including the US, will pivot again to easier policy. And that will be inflationary, and that will help Dr. Copper out. And I do expect that in 2025, maybe not until Q2, but maybe sooner if policies are announced that are inflationary enough and the markets, which are forward looking, start pricing that in. That could happen in advance of actual policies and spending hitting the economy.
Sorry, I'm confused. What's the spending? What's the policy that's going to cause more industrial spending and demand?
inflationary policies writ large. Any
Okay.
country anywhere that's struggling with economic weakness is, I can't tell you exactly yet which policies are going to be spent.
I
We
see.
may not have the Inflation Reduction Act 2.0, but it'll be something, David. And if you're going to cut people's taxes, no taxes on tips, no taxes on overtime, no taxes for uh, you know emergency responders and so on, that's money that goes into the economy. That's spending that goes into the economy. And so they buy more stuff. And if you're going to buy more stuff, you need materials, natural resources to make that stuff. And as the markets, forward-looking markets, price that in, I would expect that we would see higher copper before the spending actually hits. And I would expect this not to be just a U.S. phenomenon. I would expect it to be global. Poor China. It reminds me kind of Mario Draghi when Europe was struggling with low inflation, and he said, "We'll do whatever it takes to get inflation up to 2%." Well, they blew way beyond that. But I feel kind of like Xi is in that same place where they keep trying to put all these stimulus programs in, and they still can't get the economy over there to respond as they hope. But at the end of the day, the printing press always wins, and China doesn't even have to print that much. They have reserves. They don't have to borrow in order to spend the way the U.S. does. We're getting off the side point here, David, but I think the general inflationary context, as more of these money helicopters fly around the world,
Yeah.
is good for all commodities. And the reason why I pick copper is not because it's Dr. Copper. The reason why I pick copper is because, unlike oil, for example, another essential economic mineral, is that oil is facing voluntary supply cuts. OPEC Plus keeps extending their cuts because they're worried about a supply glut if they produce as much as they can. That's not the case with copper. With copper, we have currently an almost balanced market, but it's been on the deficit. But we keep having these shutdowns and roadblocks and nationalizations. The thing that happened in Panama was a big deal, and who's to say that's the last one? So I see the reasons why I'm so bullish on copper is that it has specifically supply constraints in a period of looks like forecastable increased demand. And one more point on this, there's scuttlebutt out there going that, this copper, the bull case for copper is overblown because it's all built on optimism about electric cars and AI, and that's all hype. It's not real. And so the copper demand isn't going to be there. Well, I completely disagree with this. And I kind of understand where it's coming from, because if you listen to Wall Street types talk about copper, they do talk about the AI and the electric cars and all that stuff. But if you talk to copper miners or people in the industry, they'll talk about Dr. Copper, this essential industrial mineral. And the projections for the supply deficit in copper are all huge. And many of them, they'll break out the deficit without the electric cars and with. And with, it's even huger, but it's still big even without selling any more electric cars or AI or any of that stuff. So again, takeaway for the audience here, I may be wrong, I may be right, we'll see. But you will hear people dismissing the copper bull thesis on the basis of EV and AI demand. I think that's wrong.
Well,
My bull case, at least, is not based on that.
what is your bull case? I'm just going to give you some obstacles, I guess, to a bull case. This is from this week. China's economy loses momentum. We know that China's construction sector was a big boom for copper, at least in the last decade. It's been losing steam for a while, right? Retail sales down, investment in buildings down. We know earlier in the year, youth unemployment is up. This is also from the
Yeah,
Wall
no,
Street
no,
Journal.
I
Yeah,
get it.
yeah,
But can you imagine, David? Can you imagine Xi saying, "You know what? I give up. I just can't get this economy to pick up steam.
yeah.
I'm picking up my marbles and going home." That's not going to happen. They will stimulate. They will come up with a new
Sure.
package until they get things going again, one way or the other. So I just don't believe that thesis. And that's one country. I would say the more problematic one would be Europe, where even if they recognize that they got to do something, it's not one country. It's fragmented. It's more
Hmm.
difficult for them. But again, Europe is
Yeah.
more socialistic than the US. It's much easier for them to want to spend their way out of trouble. Even Germany is looking at releasing their so-called debt brake, and they're amongst the most fiscally conservative in all of Europe. So, and ultimately, politicians are politicians. So if there are riots in the streets and people unhappy, they will spend, I think, uh, sooner or later. So I just I don't see austerity anywhere outside of Argentina on the global stage. And therefore, I think that these concerns about a weakening demand case for copper are not going to be realized. And also remember that aside from the housing in China, they just make a lot of stuff. They export copper tubes, like they import the raw copper and they export copper goods, the copper itself, and they also export things that the copper goes into it, including cars. China is now the biggest auto exporter in the world, not to the US, but globally. And those cars, whether they're electric or not, they have they have a lot of copper in them, David. So we can't ignore the past. And I'm not saying that any of this turmoil that you've highlighted doesn't matter.
Yeah.
That's why I've been in this hard landing camp.
Well,
And that's why I'm saying that I'm not rushing out to buy copper today.
I'm actually more
But I
curious as to why you're not as bullish on the other metals, gold and uranium. Well, I mean, maybe you are, but you're higher
Okay, all right.
conviction
I
on
have an
uranium.
answer for that
Yeah,
too.
you're
No,
higher
that's
conviction
that's a good
copper.
question.
Let's start with
Right.
gold
Well,
first.
so
Yeah.
the answer for that is the chart you just showed up. Copper is relatively cheap.
Yeah. All right.
So
Put this
for
back
copper
again.
to go up 50% from here wouldn't even take it to an all-time high. Not even a nominal one. Like a copper squeeze could easily see the metal itself go up 50%, and the stocks would respond, proportionately. Whereas a 50% increase in gold, you're talking almost $4,000 an ounce. That is a much taller order, David. Or even for silver, a 50% increase takes you to around 45, which is close to an all-time high nominally. Not quite there, but it's close. Could happen. I'm not saying it won't. I'm just saying copper is the relatively cheaper one. And it is the one facing a more serious supply constraint. Uranium is different, of course, but even there, at 75, $80 a pound, to go up 50% from there, that's a tall order, especially when the current price level is incenting new production. There are people building uranium mines now. There are people bringing old uranium mines off of mothballs now. That is happening now. And that supply needs to be digested. And I'm not a bear. I'm not saying uranium's going down. I'm just saying in this context where supply is coming on, it's harder to argue for a big raise in uranium prices in the year ahead. From my view, copper just has the best sort of price advantage, supply constraints. And one more thing, could I see optimistic news and let's say there's peace in the Middle East and there's peace in Ukraine and there's optimism that Trump and Doge are going to fix the US economy, everything's fine. I could see gold retreating substantially, gold and silver retreating substantially there. A big retreat. Gold could go back to $2,000. I'm not predicting that. I'm saying that could happen. Whereas, what's going to happen that's going to send copper down to $2 or something? I just don't see that. So I see on a risk adjusted basis the greatest reward in copper. Now that doesn't mean it's the only thing I'm bullish on. Yeah. I'm just saying if you add the risk into the scenario here and the potential upside, I like copper the best for this year ahead.
Yeah, you're not saying it's going down to 2000, but there's a greater likelihood of copper going up at current levels than gold. Is that basically what your thesis here?
Yes.
Okay.
There's a higher probability of a bigger percentage gain in copper, and there's a lower possibility of a larger retreat. I mean, look at your chart you've got on the screen right now.
Yeah, that's
going
gold.
down to $2,000. That's not even a year ago, right? That would not be hard to do. And if gold went from 26, 27 to 2,000,
yeah,
what
true.
do you think would happen
It's
with gold stocks?
$2,000 beginning of the year.
Right. So imagine going back there and what that would do to the gold stocks. They would absolutely crater. Again, I'm not predicting this. I haven't sold gold stocks on this. I'm just saying that is a risk in the gold space that I think is essentially non-existent in the copper space.
Yeah, fair enough. Lobo, what's the upside for gold since we're talking about gold? Is there any upside left at 26.25?
Yes. I wouldn't be surprised if what we're seeing here is another sort of shoulder, if you will. I'm not a technical analyst, but we saw gold consolidate, for a long time around 2000, fluctuating up and down substantially, really since 2020, before it broke out again. Given the inflationary aspects, there could be big scares. Like I said, you could see substantial retreats, but the inflation is still coming. The money printing is still happening. And by the way, whether there's peace and rainbows everywhere around the world or not, the central banks are still buying. Even China's back buying gold again. So where I said it's possible we could see a big drawdown, I don't actually expect that. I do think we could see another period of consolidation before another major breakout, though. I have a feeling that we'll probably see higher prices over 2025, but not a lot. Let's say it goes to $3,000, David, from here. That's not actually a huge gain from where we are now on a percentage change basis. What's
That's
that?
about 15%. Yeah.
Something, yeah, I mean, that would be nice. I'd take it, but it would be less than last year. So, yeah, I would not be surprised to see sideways chop, but I would say sideways to up over the next year.
I mean, 3,000 would be, first of all, unprecedented. I wonder if
Yeah.
that would just be a psychological resistance
Yes,
level.
yes. And you never know, right? Markets can get frothy. If gold becomes the flavor of the day and people just all decide to pile into gold, 3,000 itself could trigger 3,500.
You brought up
Good.
gold, gold stocks as well. Let's talk about stocks for a minute, okay? I've come to the realization that not all gold stocks underperformed gold. Some have done quite well, especially Australian stocks. Why is it that Australian stocks did better than some North American stocks? Take a look at this is
Yeah, yeah.
GDX versus gold, okay? This is GDX versus gold. Gold still, this is year to date.
Right.
Gold is
Oh,
still
I
outperforming.
understand the question. I mean, think about
Yeah.
it. Their product is priced in dollars or it's quoted in dollars, gold, and their costs are in Australian dollars, which is down versus the greenback.
Yeah.
So, to my mind, this is not surprising at all. The more, if you'll permit me to go sideways, the more interesting question, you touched on it earlier, but we didn't follow up, is the difference between gold, copper, and silver. Which way is silver going to go? Is it going to act more like copper?
Mm.
And there was a higher correlation between silver and copper last year than there was between silver and gold. That has improved for silver this year, but we'll see. Silver is still an industrial metal. You asked before, David, if it had to do with silver being a byproduct, that it was acting more like copper until recently. And no, I don't think that's it. I think it's simply the industrial demand. There is, manifestly, measurably, visibly, a much, much increased industrial demand for silver. And so it responds more like copper to market data than gold does. It is still a monetary metal, and so it does still track gold. And I'm very unhappy about the global geopolitical events that we've seen that have reminded us. But as a silver bull, it's important to me to see that silver does still respond with gold when there's a crisis moment. It still acts like a monetary metal. So I'm not saying that silver is not money anymore. I'm just saying that its industrial side has obviously become much more important. And it's frequent that we'll see on a weekly basis, gold will do this, copper will do this, and silver will go right through the middle because it's responding to both of the drivers. On the bright side, the byproduct issue that you brought up means that if we do see more economic weakness globally and the money helicopters don't fly right away, you could see reduced copper output, which would reduce silver supply at the same time that safe haven demand would go up. And that could be pretty exciting for silver prices. We'll see what happens. But at the moment, I think the money helicopters are going to be good for monetary metals as well as industrial metals in due course.
Well, what's your thesis around uranium?
Sure. Well, my thesis is that it hasn't changed. Despite the low-hanging fruit of mothballed mines being brought back online and low-cost projects being built, both of which are happening right now. Despite that, our review of the data is that's not going to be enough to meet demand. And I'm not talking about, micro reactors in the future adding to demand. I'm talking about the world's nuclear fleet now, which is expanding now, especially with the restarts in Japan and the US. These things are happening now, and those create immediate demand. And there's a free report on this on our website. It's in the free report section. There's a download on uranium. And we've looked at this, and our conclusion is that even if all of these potential near-term sources of supply come online on schedule, it won't be enough to meet the demand. And they're not on schedule. But pretty much everybody has been reporting delays, higher costs, lower output as they bring their mines online. And so it seems pretty obvious to me that push will come to shove here, and people will realize that the supply is not going to meet demand. But until that's shown, until the companies report, and until we see the official balance shift, it's understandable to me that many investors, especially people who are not, longtime uranium investors, are not reading Justin Huhn, Uranium Insider, right? I can see why they would worry. Oh, all these new mines are coming online, so maybe uranium will go down. That in my mind explains why the spot price has retreated. I see that as wrong. I see that as an opportunity, and it is something that I'm actively looking to take advantage of in my own investing right now.
What was the reason that uranium underperformed the other metals this year? Take a look at this chart. Peaked around 113. Now it's
Sure.
down to 74.
Yeah. Well, just take a look at that chart and put a line between the starting point and the end point. And
Okay.
you can see it runs ahead of itself and it comes back. It runs ahead of itself and comes back, right? So in my mind, this is completely unsurprising. It ran ahead of itself. That spike up to $106 was excessive, let's say. And I got a lot of eggs thrown at me for saying that uranium was likely to correct from there, but boy, was I right. And for what it's worth, if you were mad at me for saying that uranium was going to correct back then please remember that now, that I'm not a permabull. I don't say it can only go up and up and up. And I'm, the guy who said it was likely to correct is now the guy who's saying it's likely to go up, for
Yeah.
whatever that's worth.
Well, if you take a look at just
My
the last couple
reason
of
for
years,
not making it my top pick, sorry,
sorry,
I still like copper better because, as we were saying, even here close to 75, $80, that's not low. We're still near the incentive price to bring production online. So I think it has upside. I think it does go back to triple digits in due course. I'm just not seeing a hockey stick here again.
if you take a look at just the price action from since 2016, the lows were around 20, and the highs, let's just take $100 as an even number, right? That's an average of $60. So is that mean reverting back down to 60, you think?
No.
No? Okay.
Well, in the first place, you went from an oversold condition, and 18 was the low, and that was happening when Japan was selling off excess inventory. The situation is completely different. This is not a linear relationship. The other thing is that you don't have the long-term contract price on there. And really the long-term contract price is the real price. That's what people are actually paying for most of the uranium that trades hands. And this also, by the way, explains the correction. When uranium went up over $100, that was way ahead of the long-term contract price. And it has corrected down to where it's more or less at the long-term contract price now, maybe a little bit under. It has overcorrected, which in my mind is actually a bullish argument for it. If you look at a long-term chart, which, by the way, we have one in that free report I mentioned, the spot price can fluctuate above and below the long-term contract price, but not for long. Ultimately, it's anchored by the long-term price, and that long-term price is still on an upward trend, and I do expect that trend to continue in 2025. I like uranium a lot still, David. I'm not bearish. I just don't see, the hockey stick potential in it next year that I saw in it for 2023.
I appreciate you coming on the show today, Lobo. I appreciate you coming on the show throughout the year. People can check out our last interviews on the channel. But thank you very much for your calls. Where can we learn more from you?
Well, yes, happy holidays to everybody. If you want to read me about my thoughts on rocks and things, just independentspeculator.com. We have a free weekly digest called the Speculator's Digest. You may or may not agree with everything I say, but I can promise that I won't spam you with a flood of daily advertisements. I hate that. You just get one email per week and decide where you go from there. Thank you for watching and happy holidays.
Happy holidays to you as well, to the audience. Put the links down below. Check out Lobo's work there. And we'll speak again in 2025. Take care.